The stock for Rivian Automotive Inc., NASDAQ RIVN, is currently trading at $16.36, reflecting a modest decrease of $0.05 or 0.30% in today's trading session as of the close on November 11, 2025 at 8:06 a.m. GMT-5, which translates to a closed market at the time of this analysis. Now, the market has certainly absorbed the incredible recent volatility, with the stock having jumped sharply after its last earnings report, moving towards its 52-week high of $17.15. That movement of almost 30% in a week, pushing against a generally challenging backdrop for many growth stocks, particularly those in the electric vehicle space, is the immediate talking point. But here is the critical insight, the unexpected development that goes beyond the headline jump. The market's initial celebration of the third quarter beat, specifically the positive revenue surprise and the narrower-than-expected loss, missed the real story, which wasn't about the current quarter's sales volume, but the quiet confirmation of a sustained and significant structural cost reduction. This isn't just about selling more R1Ts and R1Ss, it is about management finally demonstrating tangible sequential efficiency in production, evidenced by the reduction in the cost impact of certain tariffs from a few thousand per vehicle to a few hundred. That detail, buried in the analyst notes following the earnings call, points to a much healthier unit economic trajectory than the simple revenue number suggests, establishing a curiosity loop that should immediately reframe how one views the stock's recent strength. The general expectation, and the common ground we share with most investors, is that Rivian is a capital-intensive startup, struggling against the might of companies like Tesla stock and established auto manufacturers with a significant cash burn that keeps the specter of dilution looming large. People look at the price chart, see the massive drop from the IPO high, and conclude this is a high-risk gamble predicated entirely on a distant promise of volume with the R2 platform. The challenge to that conventional view, the deeper take that compels a rethink, is that Rivian is moving from being a product company that happens to make cars to a manufacturing company that is finally getting its hands dirty on the core processes that differentiate success from failure in this industry. The recent momentum is not just speculative fervor, it's a reaction to the initial proof of concept on the cost side, suggesting the path to gross profitability on the R1 platform, which is actually what funds the R2 development, is finally accelerating. The daily and weekly movement of Rivian stock over the past month has been fascinating, largely driven by the reaction to the Q3 2025 financial results. Following the report, the stock experienced a dramatic surge, reflecting investor enthusiasm over a few key figures. Revenues of $1.56 billion significantly surpassed analyst estimates, and the company posted a narrower loss per share than anticipated, reporting an adjusted EPS of -65 versus a forecast of about -0.74. However, the most compelling factor, the one that truly excited the institutional players and triggered the short squeeze effect, was the company achieving its first consolidated gross profit of $24 million. This move into positive gross margin territory, however small, is an enormous psychological and financial milestone for a scaling manufacturer. When you look at the trading volumes, they exploded immediately post-earnings, confirming a rush of new capital and the forced closure of short positions. The short interest remains high, which means that any positive news, such as the strategic Volkswagen alliance or positive cost news, can create these sudden, violent upward swings. The institutional activity, which we track closely, shows continued accumulation by major funds, suggesting conviction beyond the retail online investment crowd. This kind of institutional support, where entities like Vanguard and BlackRock maintain significant stakes, underscores a belief in the company's long-term vision and capacity to execute, despite the short-term volatility that often comes with a stock that trades with a high beta, like Rivian, making it move more sharply than the general market indexes. This is where investors utilizing platforms for self-investing must be particularly careful, as these rapid swings can be misleading if not viewed through the lens of foundational business progress, not just speculative hype. The operational front is where the tension between expectation and reality truly plays out. The expectation is that all electric vehicle companies are struggling with a soft consumer demand environment and price wars initiated by giants like Tesla stock. However, the reality for Rivian is that they delivered 13,201 vehicles in Q3, a solid figure, and more importantly, they reaffirmed their full-year production guidance, which now sits in a tighter range of 41,500 to 43,500 units. The market often penalizes even small deviations, but Rivian's ability to meet and maintain production targets in a challenging industrial environment is a major positive sign for the efficiency of their Normal, Illinois plant. The most crucial development is the sustained cost-cutting, as noted by CFO Claire McDonald, who highlighted one of the best quarters ever in automotive cost of goods sold per unit. This points directly to improved supply chain negotiations, better logistics, and manufacturing efficiencies. The general public often thinks of supply chain as simply having chips or batteries, but it's the minutiae, the small costs in hundreds of components that add up. Rivian is clearly getting better at it, and this is the direct path to the financial sustainability that all investors, from the casual user of Robinhood stock trading to the serious individual brokerage client, demand. The macroeconomic pressures, including high interest rates, certainly create a headwind for big-ticket purchases like Rivian's R1 vehicles, but the firm's focus on the premium segment, which is less sensitive to rates and the critical importance of the Amazon commercial van contract, offers a degree of insulation from the worst of the consumer slowdown hitting the entry-level EV sector. Now let's briefly anchor what the company actually does. Rivian is an electric vehicle manufacturer known for its R1T electric pickup truck and the R1S electric SUV, vehicles that are positioned firmly in the premium, adventure-focused segment of the market, offering a unique blend of performance and utility that aims to differentiate itself from the more traditional offerings, including even the high-end from Tesla stock. Their business model is vertically integrated, meaning they develop most of their critical technology in-house, including battery architecture, electric drive units, and their vehicle operating system. A massive component of their revenue and future stability is their commercial vehicle business, anchored by a significant contract with Amazon for their electric delivery van, EDV, which is designed specifically for last-mile delivery. Older reports, particularly from their IPO in 2021, highlighted this massive capital raise and the subsequent spending on their Normal, Illinois plant and the development of the R2 platform. Their past performance is a narrative of rapid scaling from zero, marked by high losses, significant research and development expenditure, and the constant battle against supply chain constraints which characterized the first couple of years of production. Investors in Fidelity ETFs that track the EV sector will know this history well. It's the classic startup script in a capital-intensive industry. The pivot we are seeing now is the move from the R&D and initial production phase to the efficiency cost-down phase. This shift is what changes the investment calculus. The value proposition for online investing in Rivian has always been a bet on their unique market position and the conviction of their core management team, especially CEO RJ Scaringi, who recently had a new compensation plan approved, aligning his long-term rewards with significant operational milestones, which is an increasingly common strategy among high-growth, high-potential companies. Looking ahead, the future outlook for Rivian Automotive Inc. is dominated by two primary factors: the R2 platform and the continued execution on cost reduction. The company's expectation is to launch the R2 SUV, which targets a much broader, more accessible price point around $45,000 in early 2026. The reality of this launch is that it represents a step change in required capital expenditure and manufacturing scale. The investment narrative, therefore, pivots to whether the current cash reserves of approximately $7.1 billion, combined with the initial funding from the Volkswagen partnership for the joint venture to develop next-generation electrical architecture, will be enough to cover the R2's launch costs without another significant capital raise. The market expectation is often that a cash burn of over $600 million in a quarter means more dilution is inevitable. The counter-reality is that the $1 billion investment from Volkswagen, along with the potential for further tranches of funding tied to milestones, provides a critical financial cushion and technical expertise that significantly de-risks the R2 program. Volkswagen's involvement is not just a cash injection, it is a validation of Rivian's underlying electrical platform and software. Furthermore, the company's planned Autonomy Day event, where they will showcase their self-driving technology developments, is a key catalyst that could shift the conversation from simply product to technology stack. A move that has served NVIDIA stock incredibly well in the data center space, and of course a strategy that Tesla stock has used to great effect. Success here would place Rivian in the same conversation as companies focused on advanced vehicle software and services. The risks are clear. Any delay in the R2 timeline,